So we're going to cover audit reports. At the end of the class, I will hand out the mock exams, which we will then go over next Tuesday, the last day of class. I'm also going to, did you say good?
The evaluation.
Why don't you?
Thank you.
So I'm also going to post, because I know some of you are going to start studying, but it's a joke because I'm really not. But
Yes, we are.
Yes,
is first. I don't have a lot of time for that. Very nice. There's no way 2 days before.
yeah. Well, you'll have the mock exam. I'm going to post like an overview exam pointer overview. I'll post that over hopefully tomorrow, by tomorrow. So you'll have that. So just look out for it.
Okay. There's going to be so much content.
I wish I could say it's not, but then I would be lying. All right, so audit reports. This is what everybody turns to when they pick up a set of financial statements, except you guys. You look at the financial before you look at the audit report, right? But everyone looks at the audit report, and the audit report is sort of, for most people, sort of like pass-fail. What did the company do? Did they open it up? Did they get a clean audit opinion or not? So we're going to start with the premise that, and actually, overwhelmingly, there are more clean audit opinions. So there's a huge number of audit opinions are clean, unqualified, unmodified types of opinions. And so we'll talk about departures from, what scenarios give rise to a departure from the unmodified audit opinion. So let's just start off by talking about what the auditor's responsibilities are in terms of the report. So as with most areas this semester, we really focus on it from a public company perspective. And the audit report, with a few minor changes, the requirements are basically the same. But for a publicly held company, the auditor issues 2 reports. One report is on the effectiveness of internal controls, and the other is an audit opinion on the client's financial statements. Those reports can be issued separately, or they can be issued as integrated reports. There's no requirement one way or the other. The other thing that happens in the reporting is management also reports on the effectiveness of internal controls, but the auditor issues a separate report. Publicly held non-public companies, auditors are not required to issue a report on internal controls. They simply issue a report on the financial statements and the related disclosures. So there are several types of opinions. So we have what we call an unmodified, or you can hear it's referred to as a clean opinion or unqualified opinion. But basically, that opinion is saying that the financial statements are in accordance with GAAP, and there are no material misstatements, no qualifications, right? So it's prepared in accordance with GAAP. Whereas a qualified opinion is also referred to as an except for opinion. And what an except for opinion says is, except for this matter, the financial statements are in accordance with GAAP and fairly represented. So it's we'll talk about how that's discussed in the audit report. In adverse opinions, it's not in accordance with GAAP. So that's a bad opinion. It's not in accordance with GAAP. And a disclaimer of an opinion means that the auditors say, we can't give you an opinion on the financial statements. So we'll talk about each of these scenarios in more detail. So when we look at the standard report, so I'm going to ask you to kind of read along because I didn't do my glasses. If you take a look at chapter 12, I'm not going to be able to see because I don't have my glasses. Oh, my eyes are so bad. I can't even see out of my own glasses, honestly. No, I should be okay. I should be able to. This is really sad. Old age, I'm sorry. All right. So if you look at exhibit on page 545, right? So we're going to focus on a public company. Exhibit 12.2. And so key things that the audit report has to point to. Independent. So we started out the semester talking about the importance of auditors being independent. In the report, they remind the readers of the financial statements. We are independent, right? So it's a report of the independent public accountants. The report is addressed to the board of directors. So it's addressed to the client or the shareholder and the shareholders. The report date, if you look down at the bottom of the report, remember when we talked about completing the audit, a key date was the date that the auditor signs off. Right? That's the date that they complete the audit. That is also the date that they use for the audit report. It's the date that they determine that they've collected sufficient and appropriate audit evidence. And then it's signed by the accounting firm. It's not signed by the partner. The partner name doesn't appear on the report, I should say. It's signed by the accounting firm. Some other key elements in the report, components of the report, is the introductory paragraph. And what the introductory paragraph focuses on are the financial statements and the years examined. There's also in the report management's responsibility versus the auditor's responsibilities. So the management's responsibility section basically says management's responsible for these financial statements. They have to take ownership for them. And that management is also responsible for internal controls. That's in the report on internal controls. Whereas the auditor's responsibility section talks about the auditor is responsible for issuing an opinion on the financial statements, that their audit was conducted in accordance with generally accepted auditing standards, or if it's a publicly held company, the PCAOB, Public Company Oversight Board, so forth, right? So the PCAOB standards if it's a publicly held company, and that the audit provides reasonable assurance. And so I want you to take a look at, the second paragraph in Exhibit 12.2 and note some key words in that paragraph. And some of the things that they point out to the reader is this idea of reasonable assurance. They talk about performing they perform it on a test basis because they want to convey to users of the financial statements that we're not providing you with absolute assurance. This is what reasonable assurance means. It means that you're doing some things on a test basis. It means that there are estimates just inherent in the financial statements. So we can't provide absolute assurance. So it's important for auditors to stress what they're doing, and that's called the scope paragraph. Then finally, the opinion paragraph, the Big Ben, the auditor is giving opinion that the financial statements are presented in accordance with the applicable financial reporting standard, which in our case is generally accepted accounting principles. And that and they also, after the opinion paragraph, the very last paragraph refers to the auditor's report on internal controls. And when we look at the report on internal controls, that very last paragraph of that report will refer to the financial statements, the report on the financial statements. So those are the key things that the auditors, because the auditor is communicating to the users what they've done, what their responsibilities are, and what their opinion is. So one thing that I want to talk about, since we're on the first page of this report, one of the things that's new is that the auditors will now have to add additional verbiage to their report as what we call critical audit matters. And I'll talk and go into that in more detail. So the audit report is actually going to become even more than just these three or four paragraphs. So let's talk about, so that's our standard audit report. That's the template. That is when it's unqualified, everything is good and right with the world. But we don't always have that situations. We have situations where there are departures from the standard unmodified report. The textbook goes into group auditors, when the auditor is not independent. But for our class discussion and for the exam purposes, I'm only going to focus on two of those departures. The first being a GAAP departure. So we remember in the opinion paragraph, the auditors say that the client the financial statements are in accordance with generally accepted accounting principles. That's our financial reporting framework. If a company departs from GAAP, they might have a very good reason to depart from GAAP. But if they depart from GAAP, that has to be discussed in the audit report. So here's a simple way to kind of look at this is the departure material? So the auditor determines if it's a material departure. If the auditor determines that it's not a material departure, there's no reason to modify the report. Right? You issue a standard unmodified audit report that we just discussed, with the components that we just discussed. If the auditor determines that it is material, this departure from GAAP is material, then they ask the question, is it pervasive? So the fact that the company has departed from GAAP, does it have a pervasive impact on the financial statements as a whole, or is it just impacting this one area? Right? Does it render the entire, set of financial statements, materially impact the entire set of financial statements, or does it just impact this one area? So if it doesn't, if it's not pervasive, it's restricted to a particular area, then the auditor will issue a qualified opinion, an except for opinion. We'll talk about the wording in a moment. But if the auditor determines that it is pervasive, that means it materially impacts the entire financial statements as a whole, all accounts, then it's going to be an adverse opinion because the auditor cannot say that the financial statements are in accordance with GAAP if it has a pervasive effect. So if you take a look at exhibit on page 12.4, I'm sorry, exhibit 12.4, page 548. You take a look at page 548, exhibit 12.4, that's an example of a qualified opinion and except for opinion. And so what you'll notice for the qualified opinion, that there's no modification to the intro paragraph, it stays the same. There's no modification to what management's responsibilities are versus what the auditor's responsibilities are. The scope is still going to be the same. Management is still responsible for the financial statements. So those three paragraphs or sections do not change. What will change is the opinion paragraph. So the auditor will modify the opinion paragraph and they will add an explanatory paragraph prior to the opinion paragraph. And in that explanatory or additional paragraph, as you'll see here, in the exhibit, the auditors provide a basis for their qualification. So they're communicating to the reader why they're qualifying the opinion. The qualification is not a bad thing, right? It's just that, the auditor wants to say, bring attention to the reader. We can't say that everything, is in accordance with GAAP. It's not pervasive, but here's a situation where it's material and it's a departure from GAAP. So they add that explanatory paragraph. Notice they add the dollar impact of that departure as well, the impact. And then in the opinion paragraph, they say, in our opinion, except for. That's where we get the except for opinion, right? Except for, as discussed in the preceding paragraph, right? Financial statements are in accordance with GAAP. If there is an adverse opinion, the audit, again, no changes to the first three paragraphs because none of those things change as a result of the departure from GAAP. However, the opinion paragraph is going to change, and the auditor is also going to explain why, identifies the departure from GAAP in an additional paragraph prior to the opinion paragraph. And the opinion paragraph will give the wording that says that it was modified to note that the financial statements are not presented in accordance with GAAP. So there's no except for, because it's pervasive, so it's an adverse opinion. Questions? Right, pretty straightforward. So that's a GAAP departure. The next type of departure or modification relates to scope limitations. So that's when there's an imposition placed either by circumstance or by the client on the auditor's ability to collect audit evidence. Right? If they can't collect audit evidence about assertions, then they can't give an opinion on that account. So let's talk about the auditor's approach. So when you have a scope limitation, right, what the auditor is going to decide, again, same decision tree, is it material? If it's not material, then there's no reason to modify the report. We issue a standard report. If it is material, then is it pervasive? And again, with either being that this scope limitation has a material effect on the financial statements as a whole, versus it impacts a particular area, material. So, but before they get to that, I'm sorry, I see this. Before they get to, once they determine it's material, can they perform alternative procedures? So an example might be, let's say for some reason the auditor is unable, for circumstances, the auditor is unable to confirm accounts receivable, which is a required audit procedure. If the auditor is able to review subsequent cash receipts or collections, and they're able to gather sufficient and appropriate evidence about accounts receivable, then they don't have a scope limitation. Right? They're able to perform alternative procedures. And as long as they feel that they have gathered sufficient and appropriate evidence, they'll issue an unqualified report, a standard report. However, if they're unable to do that, then they ask, is it pervasive? If it is pervasive, they're going to issue a disclaimer of opinion. And it basically said, we can't offer an opinion, because pervasive means it has this impact on the financial statements as a whole. Whereas if it's not pervasive and it's limited to that one area, they can issue an except for opinion or unqualified opinion. So I talked about circumstance imposed versus client imposed. Circumstance imposed is something, maybe the auditor was hired later and they couldn't observe inventory. Right? That's not because a client placed a restriction on them, it's because it's just the circumstance. And so in those cases, again, the auditor would follow that decision. Client imposed is a situation where the client specifically limits the auditor's ability to perform those procedures and gather evidence. What is recommended guidance provided is that the auditor should view this as a significant restriction because the client is imposing scope limitations on their ability to conduct the audit. And in this case, a disclaimer is ordinarily issued, generally issued in those types of situations. Yes?
So if a client is not giving you information that you need, would you then go to like the legal counsel or like the audit committee to request it?
Well, you can go to audit committee. I mean, you wouldn't go to legal counsel, right? You would go to the audit committee and, bring this to the audit committee. And if there's no resolution, then the auditor, because they can't collect evidence, the client under no circumstances should put limitations on the auditor's ability, unless there's a circumstance behind it, right? It's like, we can't provide you with this information because of these circumstances, right? Such as you were pointed to late or whatever. But that's why the standards say the auditor should kind of view that as a significant. So, in a qualified opinion, right, where it's not pervasive and the auditor could not perform alternative procedures, the auditor doesn't, there's no modification to the auditor's introductory paragraph or management's responsibilities or auditor's responsibility. Instead, the auditor adds a paragraph prior to the audit opinion and then modifies the audit opinion. So if you take a look at 12.7, Exhibit 12.7, you'll see the same on 551. No modifications to the first few paragraphs, and then the explanatory paragraph explaining again the scope limitation, the dollar impact of that scope limitation. The opinion is then qualified, same thing, except for, right, referring back to the explanatory, to the additional paragraph, which identifies the scope limitation. If the auditor issues a disclaimer of opinion, meaning they can't give an opinion on the financial statements, you will see an example of that on the following page in Exhibit 12.8. So what you should know, there are tons of modifications at this point. So at this point, the auditor is going to modify the introductory paragraph because they can't say we audited, they have to say we were engaged, right, to audit. Right? So not that they audited those financial statements. Responsibilities for management doesn't change, it's still their financial statements. However, the auditor's responsibility, the scope section, right, which describes the scope of the audit, that is modified. Right, so the first paragraph is modified to note that the auditor could not obtain sufficient and appropriate audit evidence, right, because they couldn't. And then this last part of that paragraph is just gone. Because you can't say we perform on a test basis, we provide reasonable assurance, because you're not doing any of those things. So that paragraph, the basis is deleted. The auditor then adds an additional paragraph, as you'll see, which explains again the scope limitation, and then modifies the audit opinion to say, not except for, that we do not give an opinion. So when you issue a disclaimer of an opinion, you are not giving an opinion. So even though there's this additional paragraph, you make reference to it, but you're saying we can't give an opinion because. Make sense? All right, so those are the two that we're gonna talk about. So those are the two modifications, right, that requires modifications to the audit opinion. Audit opinion and the addition of an explanatory, additional paragraph prior to the opinion. It's before the opinion, right? And of those modifications, the scope limitation, when there's a disclaimer of opinion, requires the greatest level of modification to the throughout the audit report, to the scope paragraph and to the introduction paragraph as well. So that requires the greatest amount of modification. So we also have other matters that affects the audit, that the auditor would report on in the audit report. The difference is that these matters don't impact the audit opinion. And the explanatory paragraph is added after the audit opinion. So two types are emphasis of matter and other matter. So emphasis of matter paragraphs that uses information about something in the financial statements to provide more transparent or more explanation of something in the financial statements or about the company, so important matters, whereas the other matter paragraphs kind of focus on information related to understanding the audit, the auditor's responsibilities of the auditor's report. So where our purpose is though, we're going to focus on emphasis of matter and specifically on consistency and going concern. So consistency, we expect, clients have under GAAP different ways, permissible ways to recognize things or account for things. So for example, depreciation, right? The client can use any number of methods, straight line, double the client balance, those are all permissible under GAAP. Same thing with inventory, you use LIFO, FIFO, average cost, it's all permissible. What the standard said, or GAAP expects, is that there's consistency in the methods that you use. So if a client changes a method from last period to the current period, then that's reported on in the audit report, assuming it's material. That's an example of consistency. So in this case, the auditor would add an emphasis of matter paragraph following the opinion paragraph, where they discuss the fact that the client would, change an accounting method, right? From one permissible GAAP method to another permissible GAAP method. If the auditor thinks that the change is not justified, they could then issue a qualified opinion, which would, because they would issue that opinion based on it's a departure from GAAP. So the auditor has to identify that or agree in their judgment that the change is justified. And the change has to be from one method of GAAP to another method of GAAP. It cannot be from one method of GAAP to another, because then it's a departure from GAAP if it is not a GAAP. Points here is that emphasis of matter paragraph precedes is after the opinion paragraph. Auditors also have to evaluate, and we talked about this when we talked about subsequent events, about completing the audit, the company's ability to continue as a going concern. And so as their responsibilities in this event is that they have to determine, as they're going through the audit, collecting evidence, if there is any evidence that the company is unable to resolve whatever financial issues that they have, that they're having, that could result in them, not being able to continue in business. And again, as I said before, it's only for the immediate future, right? So they don't have to predict this 5 years out. They don't have to predict it 2 years out. And they're not predicting. They have to make an assessment, form a judgment based on within the next year, the next operating cycle, whether or not. So in those cases, the auditor evaluates, and if they have substantial doubt about the company's ability to continue as a going concern, they can add an emphasis of matter paragraph after the opinion paragraph. But the opinion is still unmodified, right? They're still issuing a clean opinion in a way, right? They're saying financial statements are in accordance with GAAP, because that's not the issue. The issue is that the company's having problems and there's doubt that they'll be able to continue as a going concern. If the auditor judged that there's a serious uncertainty, right, and that's, again, it's the audited judgment. So the going concern opinion is very much a judgment opinion, right? Because the auditor has no crystal ball about whether or not the company is going to, go bankrupt or not, not be able to continue as a going. So they're just evaluating the evidence that they receive. Yes?
Could you give an example of what would be considered a severe going concern uncertainty?
That if there's no evidence that the auditor is examined that would suggest that the client could get financing, and they having serious cash flows, are not able to pay, they're certain in the process they could be violating debt covenants, which would require them to, the loans to be recalled when they don't have the ability to pay. So the client would be in such significant financial distress and have, no way, I would assume, of being able to address that.
So would a good example of that being like AIG in 2008, if they didn't get the money from the Treasury Department?
Right.
They would have that $5 billion CBO payment that they would have made.
Even though they didn't get that kind of opinion, right?
Right, I mean,
Right.
they ended up getting money from.
Yeah, but you would have to believe that
They're not actually.
right, but also you have to believe that the conditions leading up to that existed.
Which they didn't.
Right, but they still would get it going. So that's what I'm saying, a going concern, I think we've seen lots of a few examples where companies went bankrupt and they had a clean opinion, right, for the year prior. Because there was, I can't think of anything that just happens. So they had, that just happens, that it just happened that year and it's gonna cause you to go, suffer serious financial distress.
Would you say that, like, given it, like, going concern, uncertainty opinion, would that be, like, more so for smaller companies? Because I guess, like, bigger companies will be able to finance it more easily.
Yeah, So, I mean, you've probably seen it more. I know people have done academic studies that have looked at going concern opinions, but I don't recall the size of the companies. But you would think that larger companies, similar to when you have more resources. So I think, I don't know if this class or maybe my other class brought up the idea of General Motors, right? What are they doing? They're slashing what, 15,000 jobs. They're GE?
No, General Motors.
General Motors.
General Motors.
Yeah, General Motors.
Yeah. They laid off
Yeah.
like a whole bunch of people.
Right, they're laying off like 15,000 and moving their operations, to I think Mexico or something like that, so to a foreign country. So they have the resources to be able to do those things, right? Yeah. So they have resources to cut back. I mean, it's unfortunate for their workers, but they'll start to do all those things, and they can still, and also they have a reputation. They have assets that they can sell off, right? So they're able to, stave it off. You can't do that forever, right? You can't, if you keep laying off people, then you have
Yes.
or if no one's buying your product, then it's you're just almost, forestalling the inevitable in some cases. But so larger companies, yes, are able to, maybe hold it off a little bit. And so therefore, you probably don't see them getting, when they're having problems, you don't see those companies getting these going concern opinions because and also they have, because a company knows if they're having problems, right? It's not like the auditors come in and say, ooh, you're having problems, right? They know it. So before the auditors so they more than likely already have something in place. They're doing things to try to get financing and try to, avoid going out of business. So, but you're right, a smaller company might not have the same resources. They might be a greater risk. So, but I mean, you do have large companies that have gotten going concern. It's just probably not as. And a going concern, I think the textbook gives a few stats. Obviously, when we saw the financial crisis like 2008, you probably saw more going concern opinions. Now, did you see as many going concern opinions as you probably should have seen in that environment? Because it's a judgment. It's like there's no, like, if they do X, then you do this kind of approach. It's very much the auditor's assessment of the evidence that the client provides them. And they make a judgment about whether they think, the client can, raise the, resources if they can get the resources that they need to kind of stay afloat.
So are the auditors be responsible for giving wrong going concern opinions?
Well, in the U.S. environment, any people will sue. I don't know of a case off the top of my head, but I don't know all the cases. I would not be surprised if audit firms were sued after they gave a clean opinion, and then the company ended up going bankrupt. Like, I wouldn't be surprised. I can't think of a case off the top of my head, but is that where they gave a clean opinion and the company went bankrupt?
All they were thinking,
Or filed for-
opinion, like they went, it was like they ended up being fraud and they made, I think that was
Yeah, okay. Yeah, so, they would get, they would come after auditors. Because, it's the same, we didn't go over legal liability, but audit firms are perceived, especially the larger audit firms, are perceived to have deep pockets, this deep pocket syndrome, where if a company goes bankrupt and you lost money, obviously you're not going to collect from the company, right? Because shareholders, you know this from your financial accounting class, you're the last person to get. You get whatever's left, which is usually nothing after everybody gets paid, and we all know who gets paid first, the government. And so, right, so you get nothing as a shareholder, and so where are you going to go? Right? So that's why they're going to go after the larger firms. They're going to sue them first because they figure they have the money and they have insurance.
The government goes after the firms still a lot. Like PwC, they started like
The PCOB and the SEC, right? The SEC will,
in the U.S., but also it's like there's big, like they completely miss a lot of signs in their audit with bank and Eastern Europe.
Yeah.
There's like over like $600 billion that are
it's so regulators come after.
Especially in Europe, they regulate a lot tougher than here.
Yeah, I think the regulators are getting a lot tougher after the financial crisis. I mean, it's PCOB now, but, and SEC, but,
The rules themselves,
yeah, the rules as well.
it's easier.
Yeah.
Strict on
So that's it. So again, so what? I think the audit evidence would have to be so overwhelming, I think, for them to say, and overwhelming, and I know that language is vague, but that's really what the evaluation of the going concern,
Like on his.
it is vague, right? I mean, it's judgment, right? So you can look at it one way, Apple can look at it another way, Stephanie, and come up with totally different. It's really as black and white as we have in the textbook, right? When you're out there, and then you also remember, you also have your client in your ear telling you, oh no, we're doing this, and we have this in place, and we're doing this, and so it's one of the more, I think, more difficult judgments. I don't think it's always as black and white. So those are the two. So the key takeaways from consistency and going concern opinion is both of those. The auditor would add an explanatory paragraph, in this case, emphasis of matter, after the audit opinion. But the audit opinion paragraph itself would not be modified. And only for going concern where auditors believe that it's a severe and severe case that they could disclaim where it's more pervasive. So they would disclaim their opinion. Okay. So also remember that auditors are required to report on internal controls for publicly held companies. And we talked a little bit about this when we covered internal controls. So the auditors report on internal controls. The key is that auditors they can issue an integrated report, or they can issue a separate report. But in any event, the report on internal controls, like the report on the financial statements, have to refer to the financial statements, and the report on the financial statements have to refer to the report on the internal controls. If you look in chapter 5 in the appendix, they'll give you an example of the report on internal controls. The key things with the report on internal controls is it talks about, again, independent auditor, what the auditor was, what the scope of the report on internal control, the work that they've done. 2 key paragraphs added to that report is a discussion about a definition of what internal controls represent. Because you have to recall that the report on internal controls is fairly new. This is a new, whereas the audit report has been around forever. There's been some slight modifications, but not a whole heck of a lot. So that report has been around forever, so people get it. They understand what the report is, for the most part, on the financial statements. But the report on internal controls is fairly new, and not everyone would possibly understand what is meant by internal controls over financial reporting. So there's a discussion in the report of defining internal controls, and also a paragraph that defines the inherent limitations of internal controls. So where we talk about in the financial report that it's reasonable assurance on a test basis, there are estimates. The inherent limitations are meant to convey to users there's no such thing as a perfect internal control. So just because we say that the internal controls are effective doesn't mean that it's perfect. So that's what the idea of the inherent limitations is there are inherent limitations to any system of internal controls, and then they give the report on the effectiveness of internal controls. So in terms of the opinions, similar to the report on the financial statements, a clean opinion, unqualified, standard opinion, unmodified opinion, says that internal controls are effective. So there are no material weaknesses identified, no scope limitations, so unqualified opinion. If the auditor identifies a material weakness, which again, is not the same as material misstatement, right? Material weakness means that the controls are not effective to prevent or detect on a timely basis a material misstatement. So you can have a report with a material weakness and still have a clean financial report. Right? Because all it's saying because the auditor has to evaluate, okay, if there's a material weakness, did it result in a material misstatement? And if the auditor determines that this is a material weakness, even though the control wouldn't prevent or detect, there are no material weaknesses, misstatements, right? So there are no material misstatements that occurred, but if it did occur, these controls would not prevent it. So that's why you can have a adverse opinion on internal controls, but a clean opinion on financial statements. So if there's one or more material weakness, the auditor would issue an adverse opinion. And if there is a scope limitation, they would issue a qualified opinion except for, or a disclaimer of opinion saying they're unable to provide an opinion. Just a couple of things I want to know before we go on to a couple of problems. Beginning for fiscal years, for large accelerated filers, for fiscal years beginning on or after June 30th, 2019, next year, auditors are going to have to add a section to their report that discusses critical audit matters. And then for all other filers, it will be after December 15, 2020. And so what these critical audit matters are meant to do is to communicate to users of the financial statements key issues that the auditor addresses, right, or that arose as a result of the audit. So things like challenging, subjective, or complex auditor judgment. So imagine a CAM in a company that has significant fair value measurement that are level 2 or level 3. They have to somehow address that. So CAMs so the standards say you have to do this, but you can't have a template of because you don't know every single CAM that could arise, right? Because the challenging, subjective, complex audited judgments can be different from company to company, right? So it's new. It hasn't been done here in the United States yet. There are European countries that have CAMs. I know France has they call it key audit matters, CAMs with a K. Australia has CAMs. I think the UK has CAMs. So, but in the United States, we don't know how this is going to impact the expectations gap or what users expect or how they will interpret critical audit matters that are discussed in the auditor's report. We don't know what impact it's going to have on when you disclose these critical audit matters, what impact it might have on a company's stock price. We don't know for companies that might already having trouble, what's CAM going to do, disclosing CAMs, what impact. So we don't know how users are going to interpret this, at least in the United States. There's been some academic studies that have been done, but it's all too new to really get a good understanding. So the other thing that they have to disclose now is auditor tenure. So how long the audit firm has audited this company, right? That has to be disclosed. And again, with the idea of transparency for users of the financial statements. So it's very new. We'll see the impact of it. But even still, once it's done next year, I don't know that it will still be too soon to tell what impact it will have on the market as a result of adding CAM. So those are the key developments and it's a big change for the audit report. And obviously, auditors and companies didn't want this, right? The comment letters were really interesting because from a company's perspective, that's all of the things that I raised, like how's it gonna impact their stock, you know, how people, users going to interpret these camps, yes.
Will this be on
Not until it's enacted, right, so, the current version of this, because we can't test it on anything, yet, so it won't be on the most recent version of it, but I would assume it's gonna be on there shortly after. So anytime there's a change in auditing standards, it's gonna be worked into this. Because this is an auditing standard, the critical one.
They need to take a break.
They need to take a break, we'll take the example board. So, but it will, I don't know when. I'll find out at the next, Board of Examiners meeting, when this is gonna happen. Just like I think the tax law is finally on, right, the tax changes. So that, and that wasn't law, right, when the tax law was enacted last year. And I think it's on it'll be on the current exam. Okay, so let's look at, let's work on a problem. Turn to problem 1251, which is on it starts on page 571 through 572. So it's just various reporting situations. So let's do this. Let's just walk through them together so we can go through as many as possible. So did everyone read the first 8?
Yes. Yeah.
So what do you think? What type of departure?
So looking at it, I could tell that it's a scope of limitation because you can't get the appropriate evidence, but it doesn't specify if it's client imposed or circumstance imposed, and it doesn't really say if there are, if they're able to do other substantive alternative test procedures. So I think it would be a qualified opinion.
Okay.
Yeah.
So qualified, and what does that, and how's the standard opinion qualified as a result of that? What would you do?
If you write that paragraph, that always helps.
So you, an additional paragraph, the basis for the qualification, right?
Okay.
And that goes where?
Before the
Audit opinion. And then what do you do with the audit opinion?
You put the except for.
Right, so that's the except for, right? When you qualify, you're going to modify the audit opinion and add an except for, right? So except for. So in our opinion, except for, referring back to the additional paragraph. Yes.
Can you explain why it's not a disclaimer?
So I was gonna say that. So you
Sorry.
don't have enough information, right? So it could be a disclaimer of an opinion. So on an exam, I would give you enough information, because I want one answer. So, but it does, in this case, it doesn't give you enough information. It would be, because what it doesn't tell you is whether or not it's pervasive. So if it was pervasive, then it would be a disclaimer of opinion.
Okay.
So it doesn't, so it could be a qualified or disclaimer, but you don't know enough, so. Alright. What about, forgive me, my glasses. So what about number 2? How will we handle that?
I said qualified.
Why?
Because it's only one matter with the lease, like the leases, and they've already like disclosed it, and everything's been. It's just one thing.
Right, so you would issue a qualified opinion, and that is again an except for opinion. So you would add a paragraph prior to the opinion paragraph and modify the opinion paragraph to say except for and refer back to the additional paragraph. What about number 3?
The except for also.
Mm-hmm. And
Because
why is it an except?
Company did everything they
they could. It's just that the auditors think that the loss should be recorded. So everything else is fine except this.
Right, so it's a departure from GAAP, right?
Yes.
Because based on, right, so, so it's a GAAP departure, and it's not pervasive, so the auditors would issue a qualified opinion. All right, what about number 4?
Disclaimer,
What?
because it's a circumstance imposed scope limitation.
Right. So the auditor, so remember, you have 2 types, so it's a scope limitation, and you have 2 types. And the audit, you could have a circumstance imposed or a client imposed. Right. When it's a circumstance imposed, the auditor is gonna, again, say, is it material? If it's material, can we get other additional evidence? If not, is it pervasive? If it's not pervasive, then you can issue a qualified opinion. If it's pervasive, then it's a disclaimer of opinion. If it's a client imposed, it is recommended, it's generally an auditor would issue a disclaimer of opinion, but that's still going to be the auditor's decision, right? But when a client starts to impose on an auditor, the logical question is like, what else, right? You know, what else don't you want us to look at? So usually when it's client imposed, you will see a disclaimer of an opinion, right? So with a disclaimer of opinion, how is the standard report modified?
Don't give an opinion, so your opinion paragraph changes.
So your opinion paragraph changes, but since it's a scope limitation, what else? The intro paragraph, what else? The audit, right, you would modify it with the audit, the scope paragraph, basically. But only when there's a disclaimer of an opinion and a scope limitation. Okay, what about number 5?
I think that's the one we didn't talk about, the audit group financial statements, because isn't it like a separate entity, so it's a subsidiary?
Number 5, I'm sorry, it's hard for me to read, so let me supplementary information.
Yeah. No, I'm not sure.
So this is supplementary information, right? So what's the auditor's responsibility for supplementary information? Do they give an opinion on supplementary information?
No. So is it unqualified?
It's an unqualified opinion. And if it's so sometimes you have regulatory, where there's certain information that is required, the auditor can then perhaps add an emphasis of matter paragraph after the opinion paragraph, right? So, but they would still give an unqualified opinion. What about number 6? Okay, so we didn't cover this one.
Yeah.
So number 6 is group auditors, right? Because we didn't cover group auditors, right? So number 6 is group auditors. The auditor can refer, if they're taking responsibility for it, then it's unless they find some kind of error or, departure, they're gonna issue an unmodified opinion. And here it doesn't seem to indicate anything of that nature. So they're gonna take responsibility for it. They have to determine if they refer to the group auditor, which is usually what they do, actually, so it's usually what they do, they refer to the group auditor without naming the group auditor. And you'll see in the scope paragraph, but usually in the scope paragraph, they'll explain exactly what they've done, right? And they refer to the group auditor without name. For them to name the group auditor, they have to get permission from the group auditor. But in this case, it's still a clean opinion because the auditor, it seems to be taking responsibility for the audit, and so therefore they'll just issue a clean opinion. Right, they'll talk about what they've done, right? In the for number 7, where the entity changes depreciation method?
I
No.
put qualified.
I put modified
Right,
because they can also do just the consistency, like disclaimer
Right.
about it. That's about it.
right. So the auditor, so you're allowed to change, right? You're allowed to change from, one GAAP approved method to another GAAP approved method. So what happens in that situation, if the auditor believes it's justified, then they would just issue an unmodified opinion and add a consistency, emphasis of matter paragraph after the opinion. If the auditor doesn't believe it's justified, then they can issue a qualified opinion. Right, so, then, emphasis of matter. Right, and that follows the opinion. And you would just speak about the consistency, the effect. Right, so the opinion paragraph wouldn't change. And then, alright, so number 8. What's the situation here?
The going concern.
Going concern. And what does it say? That the auditor, substantial doubt, right? So it doesn't seem that there's some extreme uncertainty, right? It's substantial doubt. So then what? Do we modify the opinion at all? Yes, sir.
It says that it's not serious enough to warrant a disclaimer, so I think it's still qualified.
Right. No,
Not qualified.
not qualified, unqualified.
Unqualified,
Sorry.
yeah.
Right, it's an emphasis of matter. Right, so they're gonna give a clean audit opinion, so the opinion paragraph does not change. They add an emphasis of matter paragraph discussing the going concern, and it has to indicate in it that there's substantial doubt, going concern. Those words have to be in the paragraph, and that follows the opinion paragraph. So it's unmodified. Let's do
So,
one.
just to summarize, when it's issue, going concern, and consistency, you can still pretty much have a clear opinion.
You have a clean opinion.
Okay.
Right, an unmodified opinion, you're just adding a paragraph after the opinion.
Yes.
And that's why the paragraph is after the opinion, because you don't want
Yeah, it's clear,
readers to
yeah.
be misled.
Okay.
Right, let's do one more just to, let's do, the very next one, 1152. So what do you think for the first one? How would the standard report be modified? Yes.
For consistency purposes, I know that they have to give the last 2 financial statements in 5 years.
Mhm.
So, I mean, they provided that information, so I feel like that wouldn't really affect the report.
So, but here's the thing, they can't report, you have to give 2 years of information, right? So if they're only reporting on 1 year, then that's so they're only gonna report on that 1 year. So they're gonna report on and say, basically, the introductory paragraph's gonna change and the opinion paragraph is gonna change and say that that's what they're reporting on. What they would then do, remember there was that other matters, right, concerning the audit, you would then, after the opinion, add another paragraph that discusses that. So it would be you would add a paragraph after the audit opinion that discusses that, because so the auditor is not gonna take responsibility for something they didn't do, right, because that opens them up to all kinds of liability.
So emphasis of matter paragraph.
Or so because this is about the audit, it would be other matters.
Wait, but we're only focusing on the emphasis of matter, or
The emphasis of matter, right, is just consistency and going concern, but this one this first example is an example of an other matter paragraph. what about number 2? What type of opinion do they give? Oh, tell us a story, Stephanie.
Well, see, I made a story, so it's automatically wrong.
So just tell me what you think.
So wouldn't you have to add an emphasis of
That's
matter?
it. See?
An emphasis of matter paragraph.
Right, you would add, because there's nothing in here to indicate that there's a departure from GAAP or scope limitation or material misstatement or anything like that, right? So you would still issue an unqualified audit opinion. The company is properly disclosed it, they accounted for the, loss of value in accordance with GAAP. So it's an unqualified standard opinion, and you add an emphasis of matter paragraph after the audit opinion. What do you think? What does this suggest? What does the scenario suggest? That the auditors have some what? Right, there's some doubt. So going concern. So how, right? And they're not saying that it's pervasive, they're just seeing a trend, right? And so how would they, if they have doubt, how would they communicate that in the audit report? About going concern.
Just emphasis.
Emphasis of matter.
But
Yes.
it would still be an unmodified opinion.
Right, it would still be an unmodified opinion, so they would add an emphasis of matter paragraph. Okay, let's do one more, and then Ivy's gonna hand out the markings here. What do you think? Can they issue an audit opinion? No. And they can't issue an audit opinion, right? That's not evidence, right? They have not collected sufficient and appropriate evidence, so they can't do anything but display an opinion, right? So for them to do anything else would be misleading to users, so, and open them up to a world of liability. So it's a disclaimer, they could only, that's all they could do is disclaim an opinion.
They can't get rid of it because they made this.
Okay. All right.